This is Professor David Weiss, speaking from New Jersey City University's Institute for Dispute Resolution and its flagship program, Connecting Bridges and Borders, which runs our daily podcast on global business and global affairs. Today, we have an enlightening conversation about Wall Street and what's happening on Wall Street. And today's special guest is Peter J. Lewis from Murphy Capital. He is somebody that has been in the business for 2 decades plus. He runs a platform that is part of PPAC Gladstone Bank and manages over $1 billion in assets. Peter, how are you today?
Hi, Dave. Good to be with you.
So, Peter, tell us a little bit for our listeners about yourself and about what you do.
So I run Murphy Capital Management, which is a subsidiary of the PPAC Gladstone Bank, and we are a registered investment advisor. We were founded in 1983 on the premise of constructing customized portfolios specific to the client. We have close to $1 billion or thereabouts of AUM. And our clients are primarily individuals and families and a few nonprofits. And in some cases, we're now working on the 3rd generation of families. So really what we do is we are the stewardships of their money, where we construct portfolios around their objective. And through full discretion, we manage those portfolios on a daily basis. So it's a nice way to help some of our clients navigate through the markets, achieve goals, whether it's a wedding or retirement, and it's worked out very well. Prior to that, I've been on working in the financial markets for nearly 3 decades. Worked on Wall Street for a number of years, managing money and doing different types of global operational duties, and spent time at a hedge fund, co-managing the flagship fund. So things have gravitated to a place now where I'm very involved in constructing the actual portfolios for our clients, and I have a team which we can get into, I'm sure, in a little bit, about how we construct and how we navigate through the daily course of business.
That's very helpful and inciting, because I think insightful for a lot of our listeners, because you have a dearth of experience that goes back through different credit cycles. And before we sort of jump into what everyone certainly, I'm sure, wants to hear about, which is our current cycle, how did you navigate the 2008 credit crisis? Maybe we can start there a little bit and then sort of compare that as we have a discussion about where we are today. Sure.
So it's a very relevant topic, because in speaking with clients, I certainly go back to 2007, 2008. As a reference point. And what we saw back then, as we know, credit tightened up and banks had trouble lending. How we navigated through that is, if we back up even a year prior to that, 2006, valuations were not overly lofty, but as we looked around, starter homes were $1 million, and people were getting credit without really having to put much collateral down, or even basically sign their name and they had a loan. As we navigated through that, we said there's something wrong with the system here, and we didn't like it. And being that we have the ability to manage portfolios using full discretion, we're able to scale back. So we de-risked portfolios to a degree. We never want to come completely out of the market, because we never know when that eventual bounce is going to occur. But when we go through cycles like that, we want to tighten up the portfolios, where maybe a 2nd-tier quality name gets removed and we replace it with a top flight name. And then we minimize some of the equity exposure, so that if we do go through a very rough period, clients aren't fully exposed to the markets, where they have some fixed income, some hedges in place to help soften against that. So very relevant reference point currently with where we are, to look back to 2007 and 2008.
So if we look at 2008 as more of a credit crisis versus what appears to be an induced artificial crisis due to a real issue, this pandemic, COVID-19, there's been a lot of discussion of what we call, or what we hoped was to become, this V-curve bounce. how are you sort of positioning your clients, and how are you looking at it from the perspective of the differences and the nuances and the strategies that were implemented in 2008, which was not an artificial injection from an existential factor, but rather was due to over leverage and over valuations of underlying credit collateral. So how do you sort of position that in today's environment, given the pandemic and its impact on the overall economy vis-a-vis the valuations itself within the stock market today?
Yeah, so again, if we take a step back 1 year, we all remember last year, 2019 was certainly a very good year. The stock market had very, very strong double-digit gains. The economy was extremely strong. Employment was strong. Everything was working on all cylinders. Well, we fast forward and we have a global pandemic that has affected every conceivable industry in the world. In 2007 and 2008, when we had a freeze in credit, so that was certainly a very serious instance, but we knew that there was a way to work out of that. And essentially, we could see light at the end of the tunnel. Now, maybe that tunnel was a little bit longer, but there was light at the end of it. With what we're going through now, there is no real game plan or blueprint to go off of, because we've never really have been in a situation like this. Sure, we've had minor pandemics, but nothing of this scale. So what we did, kind of to circle back to your question, is we last year, coming off a very good year, again, we said when we come off of a very strong year, it's not always a given that that's going to continue into the following year. So again, we scaled back portfolios a little bit. We raised a little bit of cash. We took some profits in January, and just salted some money away. And by no means did we anticipate a pandemic coming, but when we started to get early news of what was going on in China in January, we became pretty concerned with that. Again, not going through anything like this ever before, anybody really, you don't know what to do. And you don't want to overreact either, where you sell out a portfolio and in taxable accounts, you trigger large capital gain taxes that could be very unnecessary if nothing really develops. So we wanted to take a wait and see approach. And as the news certainly got worse, and we know what happened, that the markets became under great pressure and the sell-off occurred, we held our ground. We do have quite a few hedges in our portfolios to help mitigate some of the downside pressure. But like any seasoned investor, we want to ride the ups and downs of the market. We have very high quality names, very good diversification. So we know that when the markets come back, our names will come back too. But this one is also much longer and unknown. And just when we think we're turning a corner, another new issue pops up. So we are fairly invested in our portfolios, of very high quality. We're constantly discussing the markets with our clients and essentially resetting their expectations that nobody really knows where this market is going. There are certainly a lot of folks who talk with confidence about where they think the market is going, but in reality, nobody really knows. And we have an election coming up in November, which probably 6 or 7 months ago was a foregone conclusion that President Trump would probably be reelected based upon his economy and what he's built. But now that all of those gains are gone and unemployment is now double digits and 30+ million people are out of work, with the potential for that to unfortunately get a little bit more worse, we don't know if if it's a foregone conclusion, he's going to be reelected anymore. So we take that into account. We take the fact that we could be revisited by this pandemic again later in the year or possibly next year. Although we have protocols in place and hopefully a vaccine, although experts I talk to tell me that in the best case scenario on a fast track situation, 2 to 4 years is what a vaccine could take. We're hearing possibly by the end of the year, which is certainly ambitious, and we're hopeful that's the case. So as we invest and we look at the markets, we're looking at, if this does come back, how are we prepared for that? So as we get a little later in the summer, we're going to be looking at things very, very, very carefully. I think from now until the summer, we probably have, or through the summer, probably have a market that's going to be in somewhat of a trading range, unless some real unfortunate news comes out with a spike up in the infections, or the mortality rate increases, or as the states are opening, but that's not going very well. Then we could see the markets potentially retest those lows. But this is one of those years where you ride the ups and the downs for the long-term growth of the portfolio. Because if we do come out of the market, even missing 3 or 4 months of a very, very strong market makes all the difference in the world. And that can, when you do performance comparisons over a multi-year period of time, you can see why one portfolio lagged the other one tremendously, because they were out of the market for a few months and missed some upward mobility in the market. And again, not that we're saying that the market's going to shoot up. I'm not too sure that a V recovery is in the works. I think that this market is running on 2 different themes. One is the health side. And as we begin to see the health side improve, we're starting to see the market pick up a little bit. And our feeling has always been that in the throes of March, when the market was really selling off, that it was just pure panic. People weren't asking questions, they were just selling the market. And I think what we've seen as we're starting to get this pandemic under somewhat of control for now, where the curve is bending, that's a positive. And the states are beginning to open a little bit, that's a positive. So the market is potentially making up some of the sheer panic sell-off. I think once we get the healthcare piece in a place where we're all comfortable, well, now we have an economy staring us face on that is ill, and it needs some help. And certainly the Federal Reserve has given the market a big boost, as has Congress with the $2 trillion rescue plan, and talk of another potentially $3 trillion plan coming out. These all are going to be helpful, but again, are going to have long-term consequences that we can certainly talk about a little bit more.
And that really is a lot to chew on. So let's break down some of the things that you have, quite clearly provided as information to our listeners. First, let's start with this V curve, if we can. So the market sort of baked in, I think, into its numbers since March, the anticipation of this V curve. But since Powell's remarks this past week, it seems more plausible that the V curve is not something that is going to actually take place. And so if we look out, at least in the short term, how do you think the market will now sort of react to that? Are they looking for, whether it's Nancy Pelosi's proposed $3 trillion bill, or the central bank, which Powell has currently stated is not going to use a negative interest rate policy? So where does that leave then the valuations within the market from what it baked in somewhere post-March, but up until, let's say, this month?
Yeah, no, good question. So the V recovery, spoken earlier the previous months, where it had a little bit more traction as potentially plausible, was really based upon that maybe this pandemic isn't going to last very long. It's going to come in hard, it'll leave hard, and then we'll be back to work. In instances like this, we know that a lot of the job losses are in the hospitality industry, which is typically the first industry to lose jobs, but in a recovery, it's one of the first industries to recover their jobs. And really, that was the early feeling that maybe this is going to last a few months. It'll hurt, but we'll get through it, and then we'll be back. And that's kind of where the V kicks in. consensus has changed on that. There's talk of a W recovery, or the Nike swoosh type of recovery. It's really just a guessing game. I think that we need to get through this pandemic. We can't keep things closed too much longer. That's certainly going to really freeze up, and we do hear talk of depression. We're not advocates of feeling that we're going that direction, but there's a range of emotions with what you hear Wall Street talking about. We want to see things open and get money flowing again and get people working again. And not only from an economic standpoint, but also from a personal standpoint. I speak to a lot of clients who are older, who are home all day and just doing the same thing every day. That's not healthy for them. There are a lot of people who are in the twilight of their lives who, this could be how they finish out their life in a pandemic. So there are a lot of issues that are certainly impacting society, not only socially, but economically. As far as the recovery, we think it's going to be more of a slower type of recovery, where when people are returning back to work, it's going to be in a very small type of setting. We see that Disney World Shanghai opened up last week to 25% capacity. Restaurants are going to open up to 25% capacity. Everything's going to be working on a much slower, lower basis. I don't want to say our concern, but our question around that is if businesses are going to be running less, they're going to need less employees. So those employees who are furloughed, are they going to be furloughed, or are they going to be, unfortunately, lose their jobs, terminated? So all of this bakes into how we recover. And we also look at the fact that as we do open up the states and we do begin to all socialize together, I don't know how comfortable everybody's going to be getting back into closer proximity to each other. We'll be wearing masks probably, and we'll be social distancing. But when we're at a restaurant and somebody coughs, is that going to be a reason for commotion? Or if somebody isn't looking well, how's that going to play out against what's going on? So there are a lot of different issues that play into it. But as far as the recovery, we see a slower recovery. We know that this president is in a re-election year and needs to do everything he can to try to jumpstart the economy. And I think with what the Federal Reserve has done and what Congress has done, certainly is a good shot in the arm to get us moving. But I think it's going to be a slower recovery than we all probably would like to see.
Well, let's push a little bit on this, given your expertise, Peter, and what you do. Let's talk about valuations, because you raise a really interesting commentary about 25% of potential capacity of a business. And we can look at many different sectors that will apply. Certainly the easiest one is the food and service and beverage business, FF&B, or hotel businesses, or like you said, the tourism business, like with Disney World reopening, but at 25% of its normal capacity. That will equate into not only your comment about potential job loss, but let's talk about the balance sheet of the company itself. For many of these companies, would you not agree that 25% may not even be enough for them to keep their doors open, let alone even if they are able to keep the doors open, they're not making a profit? And then how will that equate to the valuations when you are looking at them from the market perspective?
Yeah, exactly. I mean, you look at smaller businesses, and we'll take restaurants, for example. They've been closed for months, so they've missed not only the normal businesses they would have, but they missed some holidays that are very important financially for them. So working at a smaller clip of what they normally do, after coming off several months of no real business at all, except for some takeout orders here and there, there's talk that potentially 1 out of 4 restaurants are going to go out of business. They're not going to reopen. But you take that across the spectrum of businesses, and the businesses that have figured out how to innovate in a time like this, where we see certain restaurants that are doing curbside service, stores doing curbside service, they're doing well, or have a very strong online presence. They're doing very well. And we look at this and say, maybe unfortunately it took a pandemic to bring us to this point, but maybe businesses needed to innovate, and this is a reason for them now to be forced to innovate. And and interesting, what we're seeing, we speak to a lot of companies, and what many of them are talking about doing is, after the pandemic is resolved, that many of their employees are going to have the option to continue to work from home. Using our company, for example, we have half the staff in the office and half the staff working from home. Everybody's plugged in technologically. We haven't missed a beat. And that's how a lot of companies are operating. We look at this, say, okay, further ripple effects that it could have is, if a lot of companies are going to afford their employees the opportunity to work from home, maybe large corporate facilities aren't going to be needed, corporate space, commercial real estate, and how that's going to impact that. So, it's certainly changing times and changing perceptions of where things are going. But certainly, I think a lot of businesses, smaller end businesses, may not make it through this. A lot of them, fortunately, have been able to get the PPP that the government has sponsored through the Paychecks Protection Plan, where they can fund payroll. We had a number of clients who we were able to grant them that so that they can continue to pay their staff and keep their businesses going. But that only lasts so long. And if this pandemic were to last into next year, then it's going to be very tough for a lot of those smaller companies to survive. You look at retail or the auto industry, food services, look at hotels, airlines, cruise ships. Those are all businesses that are hurting. And that's another impetus for why states are trying to open up, because they need those businesses to generate the revenues. And it's also beneficial to the tax for the states to get their tax revenue. So it'll be interesting to see how that plays out, but it's going to be a tough grind for a lot of those companies.
Now, you mentioned your team and some of the work that it does, and I'd like to give you an opportunity to sort of talk about your comment when you were making your first opening remarks about what your team is doing. So perhaps you can enlighten us on what you're doing with your team in terms of managing your current portfolio. And you also use the word hedge. For a lot of our listeners, they may not know what that means. So perhaps you can sort of explain what that mechanism is and why it's important to what you do as an asset manager.
Sure. So as a registered investment advisory firm, we manage money for our clients, similar to what perhaps what a stockbroker would do, where they manage money for clients. They're reaching out, they're contacting their client to say, Mr. Jones, we think Walmart's a good buy, maybe we should buy it. Where we differ is we have that discretion. We don't call out to our clients to say we're going to buy or we're going to sell. We sit down with the client when we initially formulate the relationship and get a good understanding of who they are and what their risk tolerance is and what their objectives are. And then we create a portfolio of stocks and bonds around that. And then we manage it on an ongoing basis. So my team is very involved in monitoring the stock market, monitoring portfolios, monitoring individual holdings. We look at the credit quality of fixed income that we hold. To talk a little bit about the hedging side of what we do. So hedging is a way to try to mitigate downside pressure in a portfolio. So we know if we own all stocks in a portfolio and the market goes down 10%, we're probably going to be down 10%. Through an option strategy that we employ, we can minimize that risk by using different option strategies as a way to prevent any type of a downdraft of significant proportions in a portfolio. On the flip side, what that type of portfolio does is it prevents or essentially puts a lid on how much that portfolio can appreciate in value. We have some clients that are not really concerned with performing consistently with what the Standard & Poor's 500 index does. And many of you are very familiar with the S&P 500 index terminology, and that's a benchmark that is used to essentially compare yourself to how your portfolio did versus what the S&P 500 index did. We have clients that aren't concerned with what the S&P does. They say, Peter, or to my firm, we need a 6% return, and that's what I want. I don't care if the market's up 15%. If I'm up 6%, I'm happy with that. And conversely, if the market's down double digits, we want to be down a lot less than that. Now, it's not a perfect science, and it's not a guarantee that that is always going to work, but we're fairly proficient with constructing a portfolio to certainly mitigate a lot of the downside pressure. And those portfolios did extremely well the first quarter of this year through the sell-off in the market. So, you know, our client base varies. We have clients in their 20s and 30s and 40s, and clients in their 50s and 60s, 70s, 80s, 90s. So every one of them has a different type of risk tolerance or goal or objective or need for what they need their money to do. And I feel it's important for Murphy Capital to fully understand what that objective is, and then to have that discussion with a client to say, this is a portfolio we feel would be best for you. And everything we do is customized. So it's not a model portfolio, or we pull a portfolio out of a drawer and say, this is good for you. We truly get an understanding of who the client is, and then we construct that portfolio. And then it's an ongoing management of that portfolio throughout the year.
I have 4 questions for you, Peter. The first one is, if I were to be a young college grad, lucky enough to have a job currently in this market conditions, and was contemplating opening up my first brokerage account, do you think this is a good time to be entering the market?
You know, it's certainly, it would be from an educational standpoint. You know, I always say to the younger folks who join our firm that it's very important to live through a tumultuous market environment, because you will never forget it. And as you look at risk and evaluate risk, you will have a better understanding of it, right? We can all build a portfolio that goes up in an up market. That's not very hard to do, but in a down market, it's very tough. So yes, I mean, for folks who may be looking to open up a broker, absolutely. You have to remember that time is on your side. And if you're young and you have 5, 10, 15, 20 plus years ahead of you, the markets always recover, right? If we go back to the Great Depression, or the crash of '87, or the tough times in the 90s, the 9/11 attacks, the financial crisis of '07, '08, and now the pandemic of 2020. Previously, the market has always recovered and gone on to new highs. So what I always suggest to new investors is you have to essentially understand the risk. You can't panic. And listen, we manage a lot of money, and I will watch some days where we're declining a lot. And it's a very tough thing to watch, but I know that panic selling can cause more destruction to the portfolios than anything else. So for younger investors who have that time on their side, there's no better place to have your money than in the market. There's no better place to get a return. And the true wealth that most people have is created in the stock market. It's important that you understand the risk. You don't try to shoot for the stars. I tell everybody in my office, as well as clients, that we like to hit singles and doubles, because if you're consistent, you're gonna do well for the long term, and that's really the name of the game. So absolutely, if any of your viewers are interested in getting into the market, this is a great time to do it.
So on that note, I have to ask the tough question, Peter. By September 1st, Dow 10,000 or Dow 30,000?
I wish my crystal ball was here with me right now. I would coach it this way. I would say if we don't have any major negative pandemic news, if we're status quo with what we're currently seeing, I think we're in a trading range. I don't necessarily see a breakout. I don't see a major decline below the March lows that we hit last month. But again, you know, we stay in the game, but I can tell you probably 3 years from now, 4 years from now, the markets will be higher and people will look back on this and say, I wish I bought more. I wish I did more. I wish I could have raised more money to put into the stock market because that was an opportunity to begin to invest.
And, you know, and certainly, you know, I'm pushing at you on that question. You know, if you had invested after the knife fell to its bottom in 2008, I think a Dow average of about 5,000, you became a very wealthy person from 2008 forward. So,
Yes.
you know, I'm sure part of this is the remarks that you've just, you know, conveyed to the listeners. And perhaps if we stay in this trading range, certainly until the next presidential election in November, that will have a lot of impact on where things go. Peter, I want to thank you very much for taking your time today and giving some insight on where the markets are today, where they've been, giving some understanding to our listeners to be calm and patient and to understand that the market is something that is extremely important and connected to Main Street America and opening up businesses. And I want to thank you for your time and for being a part of our podcast show.
Thanks, Dave. I appreciate it. I think this is a great venue to share this type of information. And I appreciate the opportunity to be with you today.
Thank you, Peter. And this is Professor David Weiss, once again, signing off. Until next time on New Jersey City University's IDR YouTube channel for global business and global affairs through our Connecting Bridges and Borders program. I bid you adieu, a safe and healthy and happy weekend. Take care.